This is the Voice of Russia in London. I'm Tim Eckott. Today I'm in conversation with the economist Vicky Pryce, former head of the Government Economic Service. It's 4 years since the US-based investment bank Lehman Brothers went bust. When it filed for Chapter 11, the company had a bank debt of $613 billion and $155 billion of bond debt. Some people see Lehman's as the first domino to fall in a sequence of events that led to the global economic crisis, the worst since the Great Depression of the 1930s. Vicky Pryce, is that fair? Was Lehman Brothers to blame, or were there already serious cracks in the system?
Well, there had been cracks in the system. We had already seen the previous summer, in fact, the whole interbank market coming under stress, particularly in Europe. Banks were beginning to worry about each other and losing some of the trust. What we had seen at the time, of course, was concern in particular about what's going on in the American mortgage market. If you remember at the time, there was already the beginning of sort of concern that the savings banks there had to be, in fact, rescued by the government.
This was what was popularly became known as the subprime loan scandal, where people were lending money on property that really could never pay back its estimated value.
That's absolutely true. Well, it hadn't been quite appreciated. It wasn't just that they were lending, of course, to all those individuals and households which simply couldn't afford it. And, of course, there had been a political push for that to happen. There had been the belief that there needed to be a stimulus in the economy, and that actually there needed to be some redistribution of income, and lower income households needed to have access to houses themselves. And there was a real push to allow people with very dubious incomes to actually be able to borrow at very low rates. And that was the beginning, really, of what was going on in the US itself. Now, what had happened on the back of it, of course, is that there had been so much movement of capital around the world, particularly from China, but also from elsewhere, seeking higher returns, because, of course, we were already in a sort of low inflation and interest rate environment, that there was suddenly this development of mortgage-backed securities. Everyone was trying to get into the market and expanding into this US, and on the back of the US financial boom, and in fact using that as a basis for lending money to all sorts of other areas, which proved at the end to be dubious too. So it wasn't just what happened at Lehman's. It was already brewing, and it was getting worse actually by the minute. And in the UK itself, of course, we had a bank already which had to be rescued by the government in the previous year, Northern Rock. So 2008 was when it all sort of blew up, if you like, and we all realised that enough was enough in terms of trying to patch up what was going on, and that actually we were in the middle of a serious crisis.
You mentioned the subprime mortgage fiasco, if you like. It's what grabbed the popular imagination. I mean, in a way, do you think it was a cynical attempt by financiers to exploit people's wish to own property, or do you think they knew what they were doing, or do you think there was a genuine attempt to democratize the housing market? I mean, how cynical were the bankers in lending that money?
I think there was a mix of political forces, basically democratizing indeed sort of home ownership. But also, interestingly enough, I think bankers thought that through all those financial instruments that they were using, they were, if anything, reducing the risk in what they were doing. So, yes, there would have been a few who knew what was going on. That at the end of the day, there had to be someone who was prepared to pay back, if you like, what they were lending them. But actually, those financial instruments were seen as an improvement to what was going on before. And on the back of that, they felt they could actually expand the lending exponentially, if you like, because the risk was so reduced.
But, of course, what emerged to those of us who are not financial experts was, of course, that the interconnectedness of the modern financial world meant that whether it was the subprime mortgage scandal or not that was at the basis of all this house of cards, all of the major global banks were connected. And once the rot set in, there was no escape, was there, either for Europe or even the Far East?
Oh, that's absolutely true. But of course, the interesting thing is that it wasn't just the global banks. It was also the smaller banks. It was, the corner, if you like, mortgage provider in the UK and elsewhere. There were local authorities that had got into the business also of investing in dubious sort of financial instruments, which were backed by mortgage-backed securities. So it had spread everywhere. And that is why the impact has been so substantial.
Now, it very quickly became evident after whether or not they were the start of it, or, as you say, the cracks were already there for those who knew where to look when Lehman Brothers went bust. But the sheer volume of these deals that were being done, the sheer volume of the subprime mortgage loan amounts that had been given out, it seemed that nobody actually had the hard resources to back up these losses once that downturn began.
That's absolutely true. I think there was an element of being able to at least net a few things out between the various players in the market. So quite a large part of the derivatives market was owed to each other, if you like. So and there's been some clearing that's taken place since to at least reduce the amount that was out there. But yes, indeed, there had to be a sort of ultimate sort of supporter of all this, if you like. And it was very soon obvious that that supporter had to be the state, the taxpayer. And the truth is, thinking back again to what happened with Lehman's, all we economists and all sort of people in the sort of policy world here in the UK just never thought that Lehman's would be let go. That this idea that there's a moral hazard there and you have to let them go so that everyone else realises that this sort of thing can't go on. If you've misbehaved, you've got to actually suffer. We would all thought that the politicians would just not do it because the impact would be so significant. We could see that, and we were absolutely astonished that politicians, in fact, behaved quite irrational, because the interesting thing is that banks then have not been let go after that. If anything, the state has intervened very significantly, either to nationalise or support or give guarantees. And it's actually the root of what's been happening in Europe. If you look at Ireland, for example, it gave guarantees for all its banks. Now, it then had, of course, to go cap in hand to the International Monetary Fund, the European Central Bank, and, of course, Europe generally, and get bailout money to support those banks. We're now seeing that actually there is still a serious banking problem around, with banks needing huge recapitalisation all around and a lot of support. And there is a worry that at the same time that all this is happening, and of course Europe and the rest of the world is suffering from the banks not being able to lend enough because they all have to deleverage, of course, to get back to something more normal. What we're finding is that rules for banks, the regulatory environment is tightening as a result of the Lehman's fiasco. To such an extent that, in fact, lending is simply not going to be forthcoming to the needy individuals and, of course, firms to keep the economies going.
We saw that domestically here in Britain. We've seen it in the States. In Ireland is a good example, but we've seen it sort of Europe-wide in terms of the retail sector, if you like, and businesses struggling to get funding from banks without cast iron guarantees. But you touched on something else there, this idea that the state must step in. And of course, there's a lot of argument now in Europe vis-a-vis, say, the European Central Bank, the Germans. Should they be in a position to buy up the government bonds of other weaker economies? It seems like a spider's web to the lay person watching, that there is this interconnectedness and this assumption that a bank is a safe place and that indeed the state should or can step in. But of course, the state, as you've pointed out, was intimately involved in these transactions as well. So at the end of the day, the money simply runs out, doesn't it?
Well, and I suppose what you could say is that we're all in it, if you see what I mean. The government, the banks, the companies that have borrowed. But interestingly enough, also the governments in Europe, which are now complaining about having to step in and bail out, if you like, some of the countries that have spent rather a lot. It is their banks that have moved themselves into the periphery countries of Europe, which I mean the ones near the Mediterranean and also, of course, Ireland, by lending huge amounts of money and encouraging quite a lot of their booms. If you look at what's been going on in Spain in the house building sector, it is German banks which transferred money, or German banks lending to French banks, which then lend to Spanish banks, basically encouraging the huge expansion in credit that's taken place in Europe over the sort of boom years. So up to a point, it's a bit disingenuous to sit back now and say, we have nothing to do with that, you guys have borrowed too much, but actually it's us, in other words the Germans and others, who've lent the money for that to happen.
Does this strengthen the argument of those who say that actually it just isn't right that banking is as unregulated as it certainly was, and to some perhaps still isn't regulated strictly enough, that in fact it's no good having a Spanish bank that lends money to Ireland and to Greece and an English bank that lends money to China. Do you think this is weakening the case of banks' independence?
Well, I'm afraid it is, and that's basically what's been going on. With the recommendations now for a banking union, which are coming out and getting stronger by the day, what you're seeing is sovereignty actually passing in terms of regulation of the banking sector from the individual countries increasingly to a more central authority. And that central authority will be increasingly the European Central Bank, certainly for the Eurozone. And that is inevitable. What will happen, of course, is that at the end of the day, there's probably going to be huge consolidation of the banking sector in Europe. And it'll be interesting to see, of course, how many of the banks have to give up and how many countries actually give up their sovereignty. Germany doesn't want to give up being in charge, if you like, of all their smaller banking institutions that it subsidizes hugely itself so they can carry on lending to businesses. So there's going to be a bit of a fight there. But yes, I think inevitably you're right. We are going to be moving towards a loss of sovereignty and centralizing regulation.
Vicky Pryce, I wonder if we could turn to the very culture of banking and not just in the USA or Britain. We've talked a bit about what drives the need for high profits for shareholders and customers, but is the real reason behind the global crisis in finance plain old greed?
Well, it's greed, but of course the institutional investors get remunerated up to a point on what returns they get on their investments. But we've got to bear in mind that they're investing our money, our pensions. It's the insurance companies on which we depend. So this is why I said earlier, we're all in it together in a way. I think we encourage the system to develop that way. We weren't really looking the right way. And of course, everyone benefited up to a point from cheap credit. The problem now is, of course, that it's moved the other way. What individuals are paying and what businesses, particularly small firms and medium-sized firms, are paying is now higher, despite the drop in the official interest rates and drop in inflation and everything else. They're paying more now in terms of interest rates for their borrowing than they did at the time just before the beginning of the crisis. So we've gone backwards in many ways. So there is an issue right now in the UK as to how to get the money flowing again. Well, clearly, nobody will want to borrow if it costs so much. Why is it that the banks aren't doing something more? And that is because they're concerned about their own margins, because they are in a position where they need to retrench a little bit and need to recover profitability. And in many cases, they need to become profitable again so that the government can sell them. The ones that we've nationalised here in the UK, for example, are not ready to be sold yet. We did actually sell Northern Rock. But there are some big retail banks here waiting to go to the market. And, of course, they need to be profitable. And there is a big fight right now going on between the government, if you like, and the banks about whether the fact that they're not lending is because people are not asking for it, or is it because the banks themselves are just not prepared to go a step further and be a little bit more imaginative and innovative in what they do in terms of requests from particularly SMEs, small and medium-sized firms, for funding, which is crucial to get the economy moving.
We certainly heard, take a country like Cyprus, for example, that was a country that was relying on cash inflows from Russia, particularly. Has Russian money propped up the system in some way, do you believe, since this crisis got underway?
Certainly in Cyprus it has, and they have intervened to sort of support the banking system in Cyprus. And you know that Cyprus finally went and asked for a bailout from the Europeans. Well, we'll see what happens with that. But of course, they're still hoping that they might get some more money from the Russians themselves. Of course, they've been very active on the island. So yes, I agree entirely that the Russians have actually been quite helpful. And indeed, it's interesting to see countries like Latvia, which actually saw a very, very substantial drop in GDP, now recovering. But in terms of who else has been hit, the interesting thing is that the periphery countries in Europe, which is the sort of smaller countries, which haven't been able to do anything in terms of changing their exchange rate or their monetary policy themselves because of the euro, have suffered most. And we've seen, for example, Greece having a fifth year of decline, with GDP falling this year likely by about 7%.
I think we know that the crisis in places like Greece, that's a topic in itself. Vicky Pryce, former joint head of the Government Economic Service here in Britain, thank you very much for joining us today. You've been listening to The Voice of Russia from London. Today I've been in conversation with Vicky Pryce, former head of the Government Economic Service and now a financial consultant.